Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global market specialists, Oriane Parmentier.
Hello.
And Ian Vanderhorn.
Hello.
Okay, so it's been a busy week this week. We kicked off with UK politics. We've had the Sintra conference. We've had plenty of data on both sides of the Atlantic, which I think are important. So maybe that's the best place to start. We have the unusual benefit of recording this pod after NFPs, the non-farm payrolls data this week, which normally we always have to caveat that we're recording on a Thursday and the data's on a Friday. But today we've had early data thanks to the US holiday on Friday. So as ever with that labour market data, I think, there's so many individual components that really you can always or almost always find something for everyone to justify their prior. This month, I suppose it came down to the weakness on the headline payrolls number relative to consensus, albeit to be fair, it wasn't particularly weak versus our house base case. And against that, then you had the positive of a fall in the unemployment rate. So Ian, how are you weighing up those two factors and other things that we've learned from the data, and what will it mean for the Fed, do you think?
Yeah, well, I agree with you on both fronts. It definitely is a nice luxury to have this data today as we're recording, and there's definitely a lot to parse through in terms of the detail of the report, some of which I'll get into. But just to answer that last question first, in terms of how much today's labor market data actually matters, I would actually say it matters very little for near-term Fed policy, and I mean that in the sense that the data didn't necessarily show anything to validate near-term Fed tightening, nor show anything to warrant, rate cuts in the near future. So the question heading into this report and into this figure, markets were weighing the possibility of a cyclical reacceleration of the U.S. economy, both, consumer-driven. We've had an equity surge in the second quarter, but also labor market driven because we've seen some firming in the labor market. And then if you layer in the capital expenditures related to the AI build out, that was really the question. Is the US economy heading for a cyclical reacceleration here? So eyes were on this print really for validation of that. Does the Fed need to maybe act more for growth reasons instead of just Iran related energy shock reasons? So that was the market narrative, at least in my eyes, before we got this number. And we really didn't get a report, I think, that validated that. You mentioned that the total payrolls figure was lower than expected. That's, of course, right. We also got a large downward 2-month revision. So it was a weaker report on net that did have some dovish indications there. But as you said, the unemployment rate also fell. It was the lowest that we've seen since last June, so almost a full year at 4.2%. So that reads a little bit hawkish. And the mixed bag, sort of mixed messaging of this report doesn't even necessarily stop there. If we take one piece of today's data, which is the household survey, where the unemployment rate comes from, that showed that at least part of the decline in the unemployment rate was actually from a drop in the labor force. We saw a somewhat meaningful drop in the participation rate. And the household survey also showed that the number of employed people fell by over 500,000, jobs. So our economists have caveated that by sort of saying that, that's a volatile series in terms of monthly employment within the household survey. It's not necessarily something to hang your hat on, but it does point to some slack in the labor market, sort of in line with that weaker headline figure. But if I can, I think, switch gears a little bit to the wage side, the other side of the equation, the average hourly earnings came in as expected. It's still on the softer side, but we did see, start to see a little bit of an increase in payroll income growth. And that's a metric that we look at regularly and pretty closely because, it accounts for employment, it accounts for hours worked, it accounts for wages, and it's effectively a measure that pretty closely tracks consumer spending because it looks at how much, how many dollars do workers get in their pockets from their jobs. And in terms of that measure, payroll income growth, we actually saw signs from signs of accelerating off the recent lows. So that implies some tightening in the labor market. So on the other side, so I don't know if you take these few things together. I think the correct read for markets, as I mentioned at the outset of this, is that it's a pretty balanced report, but yeah, a hike in July, that's fully off the table now in my eyes. September and October, those also look like really far long shots in my view. It really just looks like an economy where the Fed can just observe for the time being, and especially now that, the new Fed Chair Warsh is deploying these forces that he mentioned. And those task forces are going to look at multiple aspects of Fed decision making, and they're not probably not going to present their findings until the end of the year or potentially even later. So, in the interim, I just don't really see the rationale behind the Fed acting to hike rates, slow the economy, and potentially, damage the labor market. That this report is a good example. The labor market is still clearly a little bit fragile. So if you were to hike rates, it's really in the name, I think, of lowering inflation faster, but inflation has been above target for 5 years. So if you just do the cost benefit analysis of that type of move, it doesn't really make sense at all to me. So, yeah, let me just wrap up here, I guess, with the market side of this. I think, needless to say, we do see a steeper curve. We did see a mild front end rally today off of the data. That should be extended, in my eyes, into the July meeting. That's definitely feels like a go with. I think there's some more hawkish pricing that needs to be pulled out of markets. So that would speak to a bit of a bear steepening. But I would also just point out the long end of the curve, since we've seen some movement there this week and last week, especially some of the steepening we've seen this week has been an equal part driven by the long end. And I feel that that's probably a different dynamic and potentially even month end related. I'll draw on the really strong equity performance that we saw in the second quarter once more, because whenever we see those types of gains in stocks, the first thing that I think of is, what did the pension funds do to rebalance those gains? Did they harvest equity gains and rotate into fixed income? And I think that was probably happening through June. We saw some support in the long end of the curve, and we saw the curve flatten out, driven in part by the long end. And then we've seen some of that reverse in recent days and in the recent week, particularly as we came into month end. So definitely see a steeper curve here, potentially driven by both sides of the curve. But let's stick with the data rather than flows, because we also had European inflation data this week, which surprised to the downside. So, how did the market respond to that, and what's your inflation outlook from here, Oriane?
Yeah, so European inflation numbers came in at the lower end of expectation. That was partly driven by energy prices, but also by a reversal in services inflation following what looked like a somewhat erratic reading last month. So we also had food inflation easing slightly, with little evidence so far that higher energy costs are feeding through into food prices. And if oil prices remain around current levels, then our economists would expect inflation to continue falling over the coming months, reaching around 2.5% by September, and then dropping well below 2% by the second quarter of 2027. As inflation has come back more quickly than expected, I would say, markets have continued to scale back their expectations for further ECB rate hikes this year, and they've moved closer to our own views. So markets are now pricing in around 25 basis points of cumulative tightening for the remainder of the year, with less than 13 basis points priced for the September meeting. And in my view, that dovish repricing makes sense. I think if oil prices continue to normalize, and in the absence of any meaningful second round effects, there is limited justification for further ECB action. Medium-term inflation expectations have remained very well anchored, and if anything, they have actually softened slightly. And against that backdrop, really, this week's inflation data should provide reassurance to the ECB that there is no immediate need to tighten policy further. We've had some questions from clients this week about whether the conflict could have a more persistent impact on core inflation, for instance. And we are not ruling out some indirect effects, but core inflation tends to respond via changes in input costs with a lag compared to headlines. So there could be some pass-through over time, but it is not the same thing as genuine second-round effects driven by wages. And as I said, inflation expectation, have remained very stable at the same time. I think it's also worth remembering that the ECB targets inflation over the medium term. So even if headline inflation is still above target by September, that doesn't automatically mean policymakers need to respond. What matters is the broader inflation outlook and whether price pressure are likely to persist over the medium term. And as I said, in that sense, the European inflation data that we had this week should comfort us in our views that there is no need, if the situation holds in the Middle East, if oil prices continue to normalize, that they shouldn't have a need for a hike in September or later this year.
And it certainly seemed like that was a view that sort of is increasingly becoming reflected in Governing Council communications. We obviously had the annual Sintra conference this week, and at the margin, I guess ECB officials were tending to be a bit less hawkish, would you say, and certainly spurred on, I guess, by that more favourable inflation print this week?
Yeah, I think the speakers at the Sintra meeting have sounded a little less hawkish, which is, as you said, understandable given the recent inflation data and where oil prices are. They've largely returned to their February levels. We had been argued for some time that ECB officials could maintain a relatively hawkish tone through the summer, and potentially even beyond the September meeting, because I think it's the main lever, or potentially the only lever they have in the current environment to try and keep inflation expectation under control. It's also sensible for them to preserve some flexibility in case tensions in the Middle East re-escalate again. But at the same time, it also makes sense to start gradually preparing markets for the probability or the possibility that there won't be another rate hike in September if the data doesn't justify further action. So overall, I would say I don't think there was anything particularly surprising from Sintra this week, given the recent developments. The messaging is also broadly consistent with our view that the ECB is unlikely to raise rates again. That is, if the situation in the Middle East remains stable, of course. But it has clearly supported a gradual repricing in markets. I think expectation had remained quite sticky following the ECB's hawkish June meeting, and the more balanced tone that we've had this week has helped move that process along, certainly.
Ian, it was also Warsh's first appearance in his new role as Fed chair at the ECB's annual Sintra conference. I mean, he was very, very careful to avoid anything that might be construed as forward guidance, but perhaps leaned slightly more dovishly on his outlook on inflation, would you say?
I think that's probably fair, but at the end of the day, he did do a really good job of giving the market very, very little new information, which, as you implied, definitely is his, is his intention. His comments about inflation were I think the optimistic piece potentially. He said that he saw the outlook improving, but to be honest, and I think that's just more of a blanket statement. I mean, how could you not see that when we have oil trading below $70 a barrel, and a month ago it was nearly $100 a barrel? And I'd also say that he did have a hawkish line on inflation. He, again, like he did with the June meeting a few weeks ago, he reaffirmed the Fed's commitment to price stability, and more specifically, a 2% target. But I also, view that the same way, right? As chair of the Fed, you're sort of inclined to say that. So I wouldn't really read through into either of those either of those statements. But like you said, markets did take it a bit dovishly. I just think that's a little bit of a reach, even though it is in line with our more dovish Fed view. But I think what was interesting, the more interesting comments, at least in my view, were on balance sheet. He wasn't necessarily as explicit as he had been in the past, before he was chair of the Fed and talking about balance sheet rundown and further QT. But he did reaffirm his view that the policy rate should be front and center in terms of monetary policy transmission, and the balance sheet should be wholly secondary. We know that he sees the balance sheet more as supporting asset prices, and in his eyes, that creates inequality between people who own assets and people who don't. And in this K-shaped economy that we're currently in, I do think that's actually a very fair sort of viewpoint of monetary policy in general. But he did imply, I think, over the longer term that balance sheet would probably continue to move lower, although it would be very slow going. And that to me just speaks to a chair who will look to, lower the balance sheet when the time is right and when he's sure that it won't disrupt capital markets. So I think it's the important takeaway here is that its balance sheet is really more of a back burner item than a day 1, 2, or 3 item. And I think that should continue to be the case, at least until we see the report from the balance sheet task force, which is one of the 5 that he created and is working right now.
Yeah, it's interesting that you sort of have that reflection on what Warsh said, because I think that was quite similar. When I was listening to what Bailey was saying through a UK lens, is that, he didn't really say anything new from a rates perspective. The BOE, like you were saying earlier with the Fed, they're in quite a wait and see mode. We've even had Catherine Mann, who arguably is the next kind of most hawkish MPC member who hasn't yet voted in favor of a rate hike. Even she was talking about, whilst risks were skewed to the upside, it's not clear that the kind of impetus to hike will appear ahead of she was talking about, the wage negotiation process at the end of the year, etc. So it feels like the BOE too are in a kind of wait and see mode, and Bailey repeated lines that we've heard quite frequently from him over the last couple of months. But he did also talk about, they all talked about the balance sheet because they were asked about it, but he too talked about the balance sheet, which isn't, I don't think, a today's story for the Bank of England or for gilt markets, but it is something that as we move through the summer, I think we'll start to focus on more. The Bank of England take a decision on the pace of quantitative tightening every September for the 12 months ahead. And so as we near that September meeting, it will, of course, become something that we are more focused on. And the comment for me that was important that Bailey said yesterday was nothing new. The fact that he was reiterating the BOE's desire to remove that interest rate risk from its balance sheet by doing QT was important, especially in the context of when you consider how well I think the BOE thinks that its repo tools are operating. So the Bank of England announced a couple of different repo tools to support the market as it went through this transition of the Bank of England shrinking its balance sheet, and we transitioned from this environment of collateral scarcity to collateral abundance. Usually you would consider that to be associated with a consequential cheapening in repo and an impact or a subsequent cheapening in swap spreads as well. But actually what we've seen in the UK markets is that money market rates have remained very well behaved. They've remained very closely anchored to bank rate. And because of that, I think the BOE would, have this perception that those tools are working as desired. And therefore, it's not proving to be a hurdle to further QT. So the combination of effective tools plus the BOE's desire to continue removing that interest rate risk from its balance sheet, I think means that quantitative tightening can continue at its current pace come September. So the Bank of England currently are running down the balance sheet at a pace of 70 billion per year. That's a small reduction from where we have been over the last couple of years in the region of 80 to 100 billion. That doesn't sound all that meaningful, but I think, in the context of our views that there will be upside pressure to gilt yields from a few different things in terms of the bank rate outlook, in terms of the fiscal policy outlook, all things that we've discussed frequently on this podcast before. It just adds another reason, I think, to see upside pressure on gilt yields as we kind of come out of the summer and enter the autumn, because the consensus view, and I take this consensus view from the Bank of England Market Participants Survey, is for a step down in QT. And so I'm just not sure. I don't see the reason why the Bank of England would vote to reduce QT, when I think, their view is very much that it's working. It's not having a huge impact in the market. Its tools are working efficiently, meaning that we're not seeing big distortions in money market rates as a result of shrinking its balance sheet. It's transitioning to this kind of repo-led system of supplying reserves very effectively, and it wants to remove that interest rate risk, and therefore why would they step down? Now, of course, I can see the arguments why they should in terms of the impact, the upside impact that it's having on gilt yields, but their assessment has always been that it's not having an outsized impact on the market, and they haven't yet bowed to any political pressure in terms of not crystallizing those losses by selling bonds. So I don't know why they would at this point.
Right. Central banks have also been in focus this week, not just because of the monetary policy path, but also with their regulatory and financial stability hat on. In Europe, there were reports of the ECB potentially increasing the minimum reserve requirements from 1% to 2%. It is unclear whether they will go forward with that, and the likely impact would be to bring forward by a few months the date at which liquidity potentially becomes an issue, which I still think would be a 2027 story. But in the UK, Imogen, the BOE made headlines as well with an FT article about the potential changes to repo. Could you tell us what was that about?
Yeah, so there was an FT article this morning about the potential for the Bank of England to introduce haircuts on gilt repo. Now, I think this is probably a podcast topic that, if it's something you're interested in, we could do, a much longer pod on. But I think perhaps for this audience, I'll keep it high level and brief, and just maybe give a bit of context as to why the Bank of England are even thinking about this. One of the things that the Bank of England has become increasingly worried about in recent years is the changing participation in the gilt market, the way that demand structure has shifted. We've gone from having very, relatively speaking, price insensitive buyers in the form of pension funds, to much more price sensitive buyers or investors who tend to rely much more heavily on leverage. And the BOE are concerned about that because of the implications that it might have from a market financial stability perspective. They are worried that having too high levels of leverage in the system can exacerbate volatility in periods of stress. So the Bank of England have been doing some work for a while now on exploring ways to improve the resilience of the repo market, to shore up the resilience of the bond market as a whole, and introducing haircuts on repo, which would ultimately, be designed to reduce the amount of leverage in the system, is one of the options that they had been looking at. It's, I guess, got a bit of attention today because in the discussion papers that the Bank of England has published so far on its work, the consultation from market participants suggested that actually, the introducing haircuts on repo could have some unintended consequences potentially. It increases the cost of transacting for what has become an important player in the gilt market. It has an impact in the way that we think about the demand for gilts, both in terms of relative value trades, but also when we think about the outlook for swap spreads, and also therefore if it has an impact on the demand for gilts and the cost of transacting in gilts, then of course it has an impact on borrowing costs for the government if that demand ultimately falls away against a backdrop of still high supply. But the timing of the article, I think, is perhaps an important point to note here. And it came today on Thursday, the 2nd of July, which is just a couple of days ahead of the something that the market is watching, the gilt market is watching very closely, which is the publication of the Financial Policy Committee summary of its July meeting, which is due next Tuesday, I believe, the 7th. So you've got, on the one hand, the Bank of England potentially looking at measures that could, reduce demand from a kind of the leverage community within the market. But on the other hand, you have the potential for the financial stability arm of the Bank of England to be looking at ways that they can change the leverage ratio framework that might, on the flip side, actually boost demand from bank treasuries and could potentially offset, any lost demand from those leverage players. Now, at this stage, I should probably advertise other podcasts where we talk about this potential leverage ratio framework in a lot of detail. We've introduced a new Bondcast series called Speaker's Corner, where we're getting on guest speakers to do deep dives on topics that are relevant to rates markets. And the first episode of that was published this week. We had James Bucknell and Ian Budge from NatWest Markets on the podcast to talk about potential leverage ratio framework. So if that's something you're interested in, please do have a look at that episode, which is hopefully in your podcast feed. But perhaps the high level takeaway from me is that, there's the potential for the Bank of England to do offsetting regulatory changes, I suppose, that could help support some lost demand. But there are, of course, major question marks over whether any potential changes to the leverage ratio framework would even be effective in terms of boosting demand for gilts. And this is something that we explore in much more detail on that separate podcast. But, are the banks even leverage constrained? Would they be buying more gilts with additional capacity? It opens up the door to buying other things, HQLA, SSAs, RMBS, etc. So it's not a given that changes to the leverage ratio requirements are coming, or that they would necessarily spur on gilt demand. But I do think it's interesting that there's this discussion on the one hand around ways to shore up the market from, becoming overly leveraged in the system, and then on the flip side, there's a very near-term discussion around ways that could encourage participation from other sort of more price insensitive, longer-term buyers in the gilt market. So I do think that perhaps the news this week raises expectations of changes, at least to the buffers next week. But like I say, if that is something you're interested in, please do listen to our podcast on the leverage ratio framework itself, because otherwise we will be here all day discussing the ins and outs of potential changes there. Right, that's probably enough for this week. Thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. And don't forget to check out our other Bondcast and NatWest podcasts, Trade Links and Currency Exchange. Thanks. See you next week.